Hi, everyone. I'm Jim Marrocco from Thinking Big Financial. Thanks for tuning in this evening. I am a financial advisor and owner of Thinking Big Financial, and going to give you a presentation tonight about some financial tips for the year end, some things to kind of keep in mind, some pointers, practical matters. And then we'll have some Q&A at the end, and whatever questions you have, whether about the material that I discuss or anything financially related, feel free to answer a question. Just one administrative thing, you'll notice there's maybe a little bit of a delay on the screen. So if you do ask a question, just give me about 10 or 15 seconds to see it. And feel free to ask all your questions throughout the entire presentation, and I'll get to them at the end. So with that, let's get started. All right, we're going to pull up the slide presentation. So as I said, 5 financial planning tips for year end. I just have to go over a quick disclosure statement here, and this is a lot of words on the paper, but really what this just means is that this presentation is really for informational purposes only, and anything you kind of hear here, you should always check in with an advisor or somebody to get professional help and see if it makes sure it's the right decision for you. All right, so the objectives for tonight are really to discuss these 5 financial tips, which I've laid out here on the slide. So first, we'll kind of tackle checking in on your financial life. We'll talk about preparing for your taxes, contributing to retirement accounts or tax-deferred accounts. And then we'll find out how your investments are doing. And as we look to the new year, how to think about setting some new goals or expectations for the new year in your financial life. And then, like I said, we'll wrap up with some questions at the end. So let's get started. So first, check in on your financial life. I like to tell people, at this time of year is a good time to reflect back. Look back at the past year and think about how things have changed for you financially. So did your income go up a lot? Did you get into some debt that you wish you didn't? Did you pay off a credit card that you are happy about? How did your financial picture change? Was it for the better, for the worse? And really just take a step back and reflect a little bit and understand the progress that you made, or if not any progress, what you might be able to focus on going forward. So that's really kind of just like taking stock. Okay, here's where I was at the beginning of the year, here's where I am now, and what happened. After that, I think it's kind of a fun exercise to think about goals a little bit. Now, goals can be kind of a tricky thing, right? Because you may or may not have very specific goals. I like to break them down into kind of 2 categories: the smaller, shorter term goals and the larger, longer term goals, and think about them a little bit differently because it does actually matter in my mind how you think about them. And like I said, if you don't have goals, it's okay too. This is just about awareness, and maybe it'll start the wheels turning and you'll think of some things or what some goals might be that you want to pursue in the future. So let's talk a little bit about those shorter term, smaller goals first. So that might be something like, had a credit card balance I wanted to pay off, wanted to save X amount of dollars in a savings account, whatever it is. It's probably pretty quantifiable and pretty easy to measure the success or not of how you've done with that. Take a moment, think back to last December, last January, whatever it was. What did you really want to check off the list? And did you get there? And let's say you didn't fully get there. You only got part of the way there. It doesn't really matter so much in my mind because you're on the way to getting to where you want to go. So you wanted to save $5,000, let's say, in a savings account, and you only saved $4,000. Well, you're still better off, right? So that's kind of the shorter term goals. Now thinking about some of the longer term goals. And this is a little bit trickier, right? So this might be something like, you want to buy a house in 3 years, or you're thinking about retirement or lifestyle change at some point. And it sounds like this really big goal and really hard to get to, and you're stuck here in the present. So how do you get there? And really, kind of reflecting on these larger goals. And what I mean is really to say, like, are you doing things actively today to get to those larger goals? So if you want to purchase a house, are you doing the things that you need to do today and in the months and weeks of the year to get there? So take a step back, think about, okay, here's kind of my larger goal. This is what I'm thinking about. And I know that I'm doing these things, or hey, I'm not really doing what I need to be doing. And then that's kind of a wake up call, and you can then learn to figure out what you need to do to get there. And like I said, again, this is kind of very focused on people that actually have concrete goals. And if you don't, it's okay. We'll just stick to kind of figuring out the progress you made and how your financial life looks differently in the past year. The most important part of all of this conversation, I put this little graphic up, is never to forget that, and this is no more true in your financial life than anywhere else, that these big goals or small goals or whatever they all start with little steps. And those little steps are really important and help you get to those bigger goals. So just keep that in mind, kind of a fun thing to remember. So number 2, preparing for your taxes. Now this could be a huge yawn for a lot of people, because it's like, it's the holidays, who wants to think about their taxes? Who wants to get out pen and paper and figure out how much they paid in taxes, right? But all kidding aside, and I put this graphic on the screen to kind of make you a little bit more lighthearted about it. But all kidding aside, it is really important actually at this time of year that you actually kind of pay attention to your taxes. And why is that important? The reason is because things that impact your tax return for 2017 need to be finalized by the end of the year, by December 31st. So if you discover that you want to take a deduction, or you want to donate some money to charity and have it count on your taxes, that's got to be done by the end of the year. And the worst kind of situation is to find out when you're doing your taxes in next year in April that you could have easily fixed something, or had an awareness like, hey, I know I'm gonna have to spend a lot of money paying owed taxes in April. So you have 3 months to prepare for it. You don't want a nasty surprise come April. And that's really the point of this exercise. And the second point that I'm trying to make here is it's really about organizing and preparing. And that's where you really should focus at this time of year. So what can you do to kind of prepare for your taxes? And I just put kind of a checklist here. It might get a little technical, so stay with me. And you can always refer back here, ask questions if something doesn't make sense. But this is just a very high level perspective on something to do. So first thing, pull out last year's tax return, the 2016 tax return, pull it out. And see if you've got an extra pay stub lying around from a recent paycheck, the most recent one preferably, but see what you have. And then I just want you to run through a quick checklist. I'll run through some of these and just to kind of get things thinking, get you thinking about some of these things. So has your tax filing status changed? Are you now married or divorced versus what you were in 2016? That's an important thing because that'll impact how you file your taxes. Has your income changed dramatically? Did you get a big raise and you're making an extra $20,000 or $30,000 a year? Or is your income kind of flat? That will also impact things. And then if you have a bunch of investments, you might realize you have some gains or some losses. Those will also impact your income that you report on your taxes. And so it's important to know, hey, I've got a large gain on my taxable income this year, and that's going to impact how much tax I owe come April. And then lastly, just thinking about deductions. So did you buy a house and now you have mortgage interest that you could deduct and property tax? Or have you made more charitable contributions this year than you would normally make? Did you contribute a similar amount that you have in past years to your retirement accounts? And all of those things, when you kind of add them all up, and I'm going to walk you through that in a second, will help give you a big picture view of how things look for you this year. So you'll know, generally speaking, okay, how much income I have, how much deductions I have, and then you subtract the two and you kind of get a figure called taxable income. And that's how you base what your taxes are based on. And so you can kind of see on your own, is your taxable income up, down, the same? And then that'll tell you, hey, I think I'm going to owe more taxes. I think I owe less taxes, whatever the situation is. And then you can plan for it. So I know we might only have 2 weeks left in the year, but you can use those 2 weeks to do some things that might impact your tax return. I keep going back to kind of the charitable donation thing, because that's kind of this time of year, a lot of people have that on their mind, right? So you might realize, hey, if I donate an extra $500 or $1,000, I could take advantage of that on my taxes this year. So those are all things to kind of keep in mind. I have on the screen here also planning some gains or losses on investments. So for the more sophisticated person who, is thinking about, hey, I want to sell this stock and there's a gain on the stock, and does that impact my taxes? You can do all this thoughtful planning. If you lost me at this point, it's okay. The point here is just to get organized. And the best thing you can really do is reach out to your accountant. Ask him or her, how's it looking this year? What should I be planning for? Should I do anything in these last couple of weeks? And then you know now, and you're prepared come April. That's really the point here. But there's one big caveat for all of this, and that is that the tax law is likely to change. I'm sure you see the news reports. There's a bill making its way through Congress. Supposedly it would pass by the end of the year. We'll see what happens. But there's a lot of banter about things that are in that bill and things that are not. And some things sound good and some things sound bad. The important thing is there are going to be puts and takes for you. There are going to be things that are beneficial. There are going to be things that are not beneficial. But you have to do the math, because all of these things taken together, you might find out you pay less in tax or more in tax. So just be mindful. That doesn't impact 2017, but it will impact 2018. And my last point here is just that because it will be a change in 2018, one thing you could do this year is just take a little bit more of deductions. It's just kind of a rule of thumb. They're more valuable to you this year than they would potentially be next year. And I can follow up with you about this if this is something that's not kind of not making sense, but I'll just leave it there for now. So third, and this kind of goes hand in hand with the tax discussion, and that is about contributing to your retirement accounts. So why is this important? So first, easy. As many of you know, there are huge tax benefits to contributing to a 401k or an IRA. If you're in New York State, you could save 30, 40 cents on the dollar putting money into a retirement account. But the important part here is, unless you're self-employed, and there are some exceptions, that you have until December 31st to make those contributions into your account. So, think about how much have you contributed already, and, is it something where can you put an extra $500 or $1,000 in if you haven't? See if you can get to the max. Now, the last question, I know this is kind of a dry topic to be talking about, and especially with a lot of younger clients, I hear a lot like, why does this even matter? Why should I even be thinking about retirement? I want to put money into a retirement account that I can't touch for 20 or 30 years. And I would just answer by saying that, yes, that's true. Once the money goes in that account, you can't touch it until you're 59 and a half or so. But why it's important is it really gives you flexibility later in life. So these things are called retirement accounts, but really you could think of it as a lifestyle change. Maybe when you get to the point where you retire, or when you're 60, say, and you want to have a second career, you were in corporate life all your whole career, and now you want to work in a nonprofit, but you want to maintain your lifestyle. And now you have a retirement account there that you can draw on to help you meet that lifestyle change. And so don't think of it, so kind of black and white as retirement means you never work again. The money's there for you to draw on at some point if you have a lifestyle change. So that's what I say. And the more saving you do, the younger you are, the more flexibility you're going to have later in life. And you get all these great tax benefits. So the maximum amount you could save, I put this on the screen here. I'm not going to read through it. You can Google this. You can find out what they are. But this is kind of the max amounts that you can put into your retirement accounts. But the most important point here is to remember that once you put money into that account, for all intents and purposes, you should think of that money as not accessible. So you have to balance the money you put into retirement accounts with how much you might need for other goals. It's a really important thing to pay attention to. I had somebody call me once, and they wanted to buy a house, but they had put all their money into a 401k. And then they couldn't access the 401k money to pay for the house that they wanted to buy. So you have to kind of be mindful and juggle these things. And it might not be the most tax efficient thing to do, not to max out your retirement plan, but it will be definitely something that helps you to balance your overall life goals, which is really the point of all of this. So on to the next. How are your investments doing? So you have an investment account. You should know how it's doing. I mean, the point of investing and saving is to have the money working for you, right? But how do you know if it's working for you if you never check, or you don't have any idea if it's doing well or not? So how do you figure this out? How do you kind of look at an account and decide, hey, it's doing okay or not okay? And I'm gonna walk you through that real fast. Now, I'm simplifying here. I'm overgeneralizing a little bit, but just follow me through here. This is something, as a financial advisor, these are things that I do for my clients, but I'm just trying to kind of give you a high level overview of how to think about it. So if you want to do it on your own, you can pull out your statements and take a look and see if you can figure it out. So let's start with the basics. Is the account value up, down, or the same since the first of the year? Pretty simple thing, right? Except point number 2 here is you have to adjust for things like money you put in the account or money you take out of the account, right? So if you're putting money in the account and the account value grows as a result of that, that's not because the investments did well, that's because you put more money into the account. So we need to adjust for more things. And then you take the ending value, you compare it to the beginning value, and you see how that changed. And most importantly, how that changed relative to the benchmark. And what I mean by that is, if you're invested all in stocks, you need to compare the performance of that account to how stocks did. If you have all bonds in your account and you say my bonds are up 3% this year, my bond account is up 3% this year, but stocks are up 20%. Why am I not up 20%? Well, you're comparing apples and oranges. So you have to always keep these things in mind. And just remember, watch that you're comparing your account to the right things. Finally, just keep an eye on your taxes and on your expenses that you're incurring in the account. You want to make sure that you're not spending too much. So here's a quick example. It's a boring math example. I'll leave it on the screen here for a minute for you to look. But basically, how I would go about calculating how an account value did. So in this example, we started with 50,000, you ended with 60, but of that growth, 2,000 you put into the account. You realize the account value is up 15%, but the stock market, the S&P 500 is up 20. So you made money, but maybe not as much as someone who was just buying a passive index fund. Find out why. Did you incur more expenses? Is it an actively managed mutual fund and the manager who's managing that money just didn't do a very good job meeting the expectations? Whatever it is, just understand what's going on. And then you can always make changes based on that. Finally, get to number 5, set new goals for yourself. So here's kind of the fun part of it. What can you do to advance those larger life goals that we were talking about? It kind of goes back to point number 1. So think about it. Again, I go back to the house purchase example. If your idea is I want to purchase a home in 3 years, sit down with pencil and paper and say, okay, this is how much I need to be saving per month. And if you're suddenly becoming overwhelmed, like, oh, this is too much, reach out to someone, an advisor. This is what I do as an advisor, but this is something that you can do too at home. Second point, I always like to ask clients, like, what do you wish was different in your financial life? So let's say you've got a credit card balance that's just on your stomach and you just want to get rid of it. Maybe targeting paying that off is one thing. Or you're just not happy with, how much you spend on whatever. That could be another thing, budgeting for that. So whatever it is, just kind of be conscious of these things, think about them, and then in the new year, you can set new goals to cover them. The most important thing here is just to remember, whatever the goals are, whether they're large goals or small goals, paying off a credit card bill or saving for a house or retirement, break them up into small pieces. And by doing that, it makes it easier to achieve, in my opinion. So if you tell someone that they need, $200,000 to purchase a home, your eyes might glaze over and you might say, how am I ever going to do that? But if you instead tell someone you need to save $1,500 a month, and then that will enable you to get to your goal, that's something that's really important. And I think that will help you get to where you want to go. So that's kind of a bigger picture overview of the 5 quick tips I wanted to give to you. I know we've run a little bit longer than I wanted to on the presentation, but at this point, we'll just kind of pause and see if anybody has any questions and answers. And like I said, there's a little bit of a delay, so let's give everyone just a moment to queue up and see what questions we get. All right, great. So I've got a question here from John, and John says, what are the most worrisome parts about the new tax bill? So first off, we don't really know exactly what the new tax bill is going to look like, but we have some ideas and we see things in the press. So I would say that, for a kind of New York-centric audience, one of the biggest things that is concerning people is the loss of the state and local tax deduction. And for a lot of people, they can deduct their state and local income taxes as itemized deductions on their tax return. And that saves them a bunch of money on their federal tax return. That's being capped or eliminated, we're not sure yet. And what that might mean is that you may no longer be able to itemize your deductions. Now, that sounds bad, but the flip side is that the standard deduction is going to be larger and the tax brackets are changing. So you might find out that even though you're losing this deduction, that you might, in fact, end up paying the same or a little less or a little more in taxes. So like I said before, you really got to do the math, but that's one thing that I hear that's very worrisome for people. Okay. Let's see, got another question here from Laura, and she says, what if I've already contributed to a 401k? Can I still contribute to a traditional IRA? And the answer is, okay, so you've got a 401k at work and you've contributed to that through your paycheck. Can you still open up an IRA or contribute to an existing IRA that you already have? And the answer is it actually depends on how much money you make. So yes, you can always contribute money to a traditional IRA. The question is, can you deduct it for tax purposes? And that depends on your income. So unfortunately, I wouldn't be able to answer that exactly for you, but please, reach out to your accountant and ask them that question, because you might be able to. Okay. Next, let's see. Joe asks, I've been saving all my money in a savings account. Should I invest that instead? So great question. Again, the answer is it depends. What I always tell people is, first and foremost, you should have an emergency savings fund, or in other words, a savings account or a money market account, something that's very easily accessible and in safe. It's not in stocks, it's not in bonds, it's in very safe, very liquid instruments, and it's easily accessible to you. So if you have an amount of money in there that covers, say, 3-6 months of your living expenses, it's your safety net, think of it that way, then I think it's okay to start investing the money. But I would not by no means take all of your savings and then put them all in the stock market and wipe out all cash you have in a savings account, because that's not going to put you in a very good situation for a number of reasons. But yeah, so once you have that amount established in a savings account, then I think it's a good time to start to invest. Unless, of course, you're saving for a very short-term goal, like you're going to buy a house next year, then you probably should be investing that money in the stock market, because you just never know, how that value will change. Okay. Let's see. So we have another question here, and it's the question is, I've saved money into my retirement account, and you mentioned on the presentation that you should think of that money as not touchable. Like, you can't take the money out of those accounts unless you're 59 and a half. And the question says, can I just withdraw it if I want to? And the answer is, yeah, you can withdraw it if you want to, but there's kind of a steep cost of doing that. Not only will you pay income tax on the money, but if you're under 59 and a half, then you're also going to pay a penalty on that money. So, again, in New York State, just to kind of continue this example, if you take $1 out of your retirement account prematurely before you're 59 and a half, you might end up with only like 50 cents on the dollar after you do that. So it's a pretty steep cost to having to withdraw money from the account. So it's not something that I would advise or tell people to kind of put the money in and then think they could take the money out, because it's probably not going to be a good idea. So, okay, let's see if there are any other questions. I'll give it another few seconds. Okay. Looks like that's it for tonight. So I just wanted to say thanks again, and it's Jim Marrocco again from Thinking Big Financial. My website here on the screen, thinkingbigfinancial.com. If you have any questions, or if you're interested in working with a financial advisor, please feel free to reach out. You can get it to me, on the website, or you can email me. It's jim@thinkingbigfinancial.com. And finally, just one last note, there'll be a replay available of this webinar, and will be sent out to you within the next couple of days, and it will be also available on the website. So if you missed anything or you want to go back to a slide, there'll be a replay available for you. So thanks again for tuning in, and have a good night.